row after row of metal doors behind a chain link fence. It's the least glamorous building in commercial real estate, and one of the most profitable. Self-storage quietly produces some of the highest operating margins, the stickiest tenants, and the most recession-resistant cash flow of any asset class. Here's the economics of owning self-storage and why both first-time investors and Wall Street giants keep pouring money into it. Start with why the model is so powerful. It's beautifully simple. You rent small spaces month to month to people who need somewhere to put their stuff. There's no expensive build out for tenants, no complex leases, minimal staffing, and very little ongoing maintenance. Compared to almost any other commercial property, the cost of running a storage facility is remarkably low, and that's the foundation of the whole investment. The numbers are striking. A well-run facility can convert 60 to 70% or more of its revenue into net operating income because the operating costs are so low. Tenants rent month to month, which sounds risky, but is actually a feature why it lets the operator raise rents quickly as the market moves. Low expenses, high margins, and pricing flexibility. That's a rare combination in real estate. So what fills these units? The industry has a saying, the 4 Ds: death, divorce, dislocation, and downsizing. People reach for storage during life's big transitions, moving, combining households, settling an estate, downsizing a home. The beautiful, if unsentimental, truth is that those events happen in good times and bad. That's what makes storage demand so steady and so independent of the economy. Beyond life events, demand keeps broadening. Homes are getting smaller while people accumulate more. Small businesses and online sellers use storage for inventory and equipment. And once someone moves their belongings in, inertia takes over. They tend to stay far longer than they ever planned. That stickiness is gold for an owner because a tenant who won't move is a tenant you can keep and gently keep repricing. And here's the quiet engine of storage returns. Existing customer rate increases. Because moving a unit full of belongings is a hassle, a tenant will almost never relocate to save $10 or $15 a month. So operators raise rents on existing customers regularly and most simply pay it. That ability to push rents on a captive base with no expensive turnover is exactly how skilled operators grow income year after year. Now, how do you actually invest? There are three main paths. You can own and operate a facility yourself, the most active, highest return route. You can own the real estate and lease it to a national operator on a net lease, far more passive. Or you can buy a stabilized, professionally managed property. Each trades hands-on effort for return, so the right path depends on how active you want to be. The biggest returns usually come from value add, buying an undermanaged facility, professionalizing the operations, lifting occupancy, and pushing rates to market. The national operators, names like Public Storage, Extra Space, and CubeSmart, have built enormous companies doing exactly that. For a more passive investor, owning the building and leasing it to one of those operators turns storage into something close to a net lease deal. Because the cash flow is so dependable, quality storage trades at strong pricing, institutional facilities around 5.5 to 6.5%, stabilized regional properties a bit higher, and value add deals higher still to reflect the work involved. Prices span a wide range from a couple million for a small facility into the tens of millions for a large climate controlled property in a major market. Now, the one risk you cannot ignore: supply. Storage is relatively cheap and quick to build, which means a hot market can get overbuilt fast. When too many facilities chase the same renters, occupancy and rates fall together. The defense is local homework. Study the existing and planned competition within a 3-mile radius before you buy. In storage, the submarket supply picture matters more than almost anything else. What makes investors love storage most is how it behaves when the economy turns. Downsizing and dislocation actually rise in a downturn, which can feed demand. The expense base is low, so margins hold up, and rents reset monthly, so the owner can adapt quickly. Through multiple recessions, self-storage has been one of the steadiest performers in all of commercial real estate, which is exactly why institutional capital keeps flooding in. Florida is one of the strongest storage markets in the country, and the reasons are structural. People are constantly moving in. Homes are smaller and most have no basement or attic. Snowbirds and seasonal residents need somewhere to keep things. Hurricanes and renovations create sudden demand. A growing, mobile, space constrained population in a warm climate is the perfect backdrop for storage, and Central Florida sits right in the middle of it. Putting it together, self-storage is a high-margin, recession-resistant business wrapped in a simple building. Low operating costs, sticky tenants, monthly pricing power, and demand that holds through any economy. The keys are local supply, the quality of the operations, and the strategy you choose: active value add or passive ownership. For investors who want durable cash flow with a real growth lever, few asset classes compete. Self-storage proves that the plainest building can hide the best business. The economics reward investors who understand local supply, operations, and the power of monthly rate growth. If you're evaluating self-storage or other commercial investments in Central Florida, that is exactly what we do at MaxLife Commercial. The link to connect is in the description.